All right, so as most of you know, I have been writing an awful lot about oil for about 7.5, 8 years now. And I first started in the space talking about the Bakken and the shale boom that was developing way back in 2011. That's how I got onto Market Watch. So I have a pretty deep background here. I had been studying oil for years and years before that. Blood of the Earth is a book about how the oil economy works, and there's all sorts of other literature out there. So I've been very deep into the oil space my entire career. My first real contrarian pick was a Petrobras back when I was with a retail brokerage that was just starting to get into investment advisory. And when I bought Petrobras, I think it was 1999 or 2000, right in there somewhere. Um, the guy that we had hired to be the in-house asset manager went to the supervisor, to the guy who actually owned the firm, who happened to be my uncle, and told me I was crazy to buy it. And I had to lay out my case for why I wanted to buy it. Basically, a lot of cheap oil assets, um, dramatically undervalued, and I thought it was funny that it had the symbol PBR, being that I'm from Milwaukee and Pabst Blue Ribbon is a thing here. And back then it was not actually that good of a thing because they had left at the time. But I've been following oil companies a long time. I understand the value propositions throughout the industry pretty well. At least I think so based on the success of my picks. I mean, I've only had one really bad year back in 2015 because I got back in too early. I did not recognize that the bear market would take an extra year or two. What is happening right now is really what I thought would have happened by last year. So, I've made some adjustments, and in the last year, have made all that money back through some of the oil stocks going up. Of course, I hit the grand slam on Exact Sciences for a 10 bagger in 18 months. And that's really just something to keep in mind, that portfolios move for a lot of different reasons. You want to make a series of good decisions, and eventually one or two or three of them end up being home runs, while other things don't get you in trouble. And that's really the focus of margin of safety investing and fundamental trends, is to make a series of good decisions, and some of them turn out to be great. So going back to the oil markets now, we know that we're in a bull market. We've seen the price of oil come off of its $26 or $28 bottom a couple of years ago, ran up into the 50s, pulled back to the 40s, and now is around $70 per barrel on a WTI and 73 or 76 or something on Brent. I'd have to double check today. And that probably isn't the end of the appreciation for oil price. Saudi Arabia is saying that they want the range to be between $80 and $100, which is what I talked about 4 years ago now, when I said that the price of oil would collapse. Was it 5 years ago? No, 4 years ago. And that is really something that I've expected. And of course, I think the price of oil can go above 100 if there's a problem with Iran that results in either A, sanctions, which I think is almost a certainty next month, or B, some sort of a conflict, which I think there will be a conflict in Iran. I hope that it doesn't involve the outsiders going in. I hope that it's a revolution that is just supported by those that can take care of the Iranian military while the revolutionaries do what they need to do. So we'll see. I will actually talk about Iran on Tuesday in an interview with Forex Analytics and Dale Pinkert again. I've been talking to them about the hot spots in the world over the course of 3 or 4 interviews in the last year. And I think that those are the wild cards, obviously, but they could drive, Venezuela is going to push the price of oil up a little bit here, but Iran could be a catalyst for really pushing it up into the Saudi Aramco um, IPO later this year or next year. So, all right. So let's start with today's article. Just anybody has any questions, you can get them off your chest. Nobody likes it when you bash an American company that's done very well for a lot of people over a long period of time. However, Exxon and Chevron are near the end of the rope. I've been talking about it for a year and a half now. They have major problems when it comes to being able to support their dividend long term and transition those companies to the lower carbon future. And that's really at the heart of my argument against them. The oil bull market will support them to some degree. There's no doubt about that. And Exxon is the #1 producer of natural gas in the United States. So you're not going to see these companies go away. However, their ability to support share price and dividends is going to be challenged in coming years. And that really stems from a couple of things. Their legacy assets are not that great. They have assets all over the world that they've written down that will never be developed because they're too long cycle, meaning that it takes a decade, give or take, to get all of their money back and profit on the projects. So whereas that made sense to do those projects in the 70s, 80s, and 90s, and even prior to the shale boom this century, those projects just don't make a lot of sense, given that the demand for oil is eventually going to fall off. And if you take a look at this chart that I've posted for about the third time now, this is my projection for oil demand over the next 30 to 40 years. And I think it's pretty clear that this is going to be somewhere the right shape of the curve, at least. Could the curve move to the left or to the right based on the timeline? Certainly. But we are going to see the demand for oil drop in half from here, and maybe lower depending on what governments of the world have to say about it. But the reality is that the electric vehicle and hybrid vehicle future is coming, and it's just a matter of how fast it penetrates. And if you take a look at the comments on this article, I get some of the same stuff over and over and over again. Where's the electricity going to come from? Look, this is a very simple thing to understand. You can choose not to understand it, but it's very simple. Solar technology and battery technology are on growth curves that are tremendous. And they're getting better and cheaper all the time. So not only does the technology get better, but as they get manufactured more, the manufacturing processes get better. You get scale, you get expertise. Already, 100%, okay, let that sink in. 100% of all net new electric generation in the United States for the last 3 years has been from renewable energy, primarily wind and solar. So to think that that's not happening is a fallacy. It might be ideological, I don't know. But the future of the world is electrified, and much of that power generation is going to come from solar. I believe commercial solar is going to be a big leader as corporations seek to secure their own power supplies and battery systems. The battery technology, which is also cited as a reason that it can't happen or won't happen forever, is just not good criticism. The reality is that the battery technology is improving quickly, and not all of it requires lithium or heavy metals or rare earth metals. A lot of it, the flow batteries in particular, you have batteries the size of a refrigerator, sure, but store the power for a home for 2 to 3 days. So, what happens when you stack those, which can be done? Now you can save power for your house that came from your solar array for weeks. The other thing to consider is that jives even better with commercial installations where they have large rooftops that they can deal with, or the fields. I think you're also going to see municipalities go to buying farms, in places where they can do it, and building facilities for battery storage and energy generation to supply the municipal buildings with energy, as well as streetlights and other things like that, so that they don't have to be subject to the utilities. Now, the utilities, on the other hand, want to be competitive, so they're pushing into renewables as well. So you have all these different forces, the commercial, the utility, and eventually the residential, probably 5 to 10 years from now, becoming big deals. And as all of these players push into renewables, that's where the electricity is going to come from. And natural gas certainly has a role. It's going to be a large role for many decades. However, coal is going away. How long does that take? I don't know. It depends on the politicians. But in China and India, there's a very good possibility that coal is gone somewhere between 2030 and 2040. Depending on how our elections go in 2020 and 2018, I think that you could see another big push to get rid of even more of the coal generation in the United States. So when we talk about energy, it's not just about oil, it's about the whole picture. All of these things are connected. And for investors, it's a matter of trying to figure out where to make the most money. Well, in the short to intermediate term, I think oil is the place to be. Now, if you don't want to be in any fossil fuels, I understand that, I respect it. But for our purposes, oil is going to simply just be a really good place to be invested, because the price level, the price plateau, what I've called the peak oil plateau, is going to keep supply and demand roughly in balance. And because the supply is managed and the demand is still going up, right, because consumers are much slower to move than corporations and governments, they're going to keep, particularly OPEC and Russia, are going to keep the oil supply just under demand for an extended period of time, to the late 2020s probably. At some point, to fight off rising prices, they'll let supply go back above demand again. So, this area in here is uncertain, but at least for the next 5, 6, 7 years, you're going to see a pretty good bull market in oil. There you go. There's my little general barking right now. How do we play this on the oil side? Well, again, I don't think it's the oil majors. I think that it is the companies that have done better to steward their assets. So, to that end, I talk about some of the companies that I'm involved in, and two of them that I've been willing to share are Occidental Petroleum, and later today there's an article going out there that'll mention Total. So one of the things, I'll just talk about the oil majors here. So Total is a major. It's the only one that I would consider owning. Why? It's a financial powerhouse that makes Exxon and Chevron look poor. It really does. It's a great handler and acquirer of assets, a leader on climate change mitigation and ahead of the curve for lower carbon future, backdoor ownership of sun power and other alternative energy assets, a strong growth and income play for retirement portfolios. I would buy it on all dips. It's a little bit frothy right now. You get it on a 5% correction. I think that's probably a good place to buy it. I want you to take a look at, and let me try to make this a little bit bigger for you. When you get a chance, like I said, this will be published to the public later today probably. It's over at Margin of Safety Investing and over on Fundamental Trends right now. Give them a head start. But again, they know about these companies anyway. We've already talked about these. Total, I've talked about in the past. Haven't talked about it much lately. But it is, if you're looking for a major, this is the place to go for all the reasons I talked about. How does it compare to Exxon and Chevron? Crushes them. Much better balance sheet for sure. So Total pays a 4.7% dividend with a cash coverage ratio down at 30%. Exxon's cash coverage ratio is 86%. What does that mean? That means that they're using much more of their earnings to pay for the dividend. Chevron, 114%. And again, these numbers will come down as the price of oil goes up, but not by a lot. For large, slower growth companies, which all of the majors are, to have coverage ratios this high, that's not good at all. All right. Now, of note, Total's dividend is subject to a French income tax, so you have to keep that in mind. You can recover some of that if you hold it in a taxable account. In the trailing year, Total churned out $3.34 in earnings with a growth rate of 89%. I don't think that growth rate will keep up, but certainly they'll be pushing into the $4, $5 earnings per share range pretty soon based on the rise in oil prices that I think is not only sustainable, but again, it's going to be that peak oil plateau where oil supply and demand are roughly matched up pretty well in an era with low inventories because the long cycle, deep water, oil sands projects just aren't coming online anymore. Take a look at the comps on the debt and cash. Total has $36 billion in cash and short-term investments, long-term debt of $52 billion, right? They're not quite debt-free, but net, they're almost net debt-free versus their market cap. Take a look at Exxon, $3.1 billion in cash, $41 billion of debt. Chevron has $4.8 billion of cash and $38 billion in debt. So all these companies have debts that are up there, but look at Total sitting on a mountain of cash. That gives it that margin of safety that I'm looking for. But wait, there's more, right? I've talked about the Permian Basin over and over again, and we'll get to that again in a minute. But the Gulf of Mexico is the other place where there's growth in U.S. production. So Total has got in on that. They acquired some bankrupt assets. They bought some blocks, partial interest in operated blocks in the Gulf, and they just had a major discovery that they share with Chevron. So Total got in on these on the cheap, whereas Chevron had to do all the exploration to have all those sunken costs. So that is really the MO, and there's an article out there. I looked for it, but I read it a while back. Total's MO is to go out and find assets on the cheap, and they've done a really good job of it. So when you go through their corporate reports and you take a look at what they own and what they paid, and then you take the time to move over to Chevron and Exxon and see how they've done things, it's pretty amazing how well Total has handled their asset base. You also go over to the whole climate change thing. I don't want to argue it, but regardless of what I believe, the governments of the world believe it, and they're pushing for alternative energy. Total is a leader in that. They own 2 battery companies. They largely own SunPower, which I reiterated a buy on. Got mocked for that as well. And they did just buy a battery company inside of the United States. Again, ask why? Why? Trump tariffs, right? So now they can produce batteries within the United States that they can share with SunPower. SunPower also has some battery ownership too. So, why don't I want Exxon and Chevron? Because Total is better there. I'm not saying anything real negative about Chevron and Exxon, even though I think they're in big, big trouble with those lawsuits. But I think Total is better. I think they just handle their company better. Bottom line, they have a better balance sheet. They have better assets. They don't have some of the headwinds, right? So when we do the core 4 analysis, we take a look at the secular trend, the long-term top-down trend. We're in an oil bull market. How long does it last? Better part of a decade for sure. So that's number 1. Number 2, government, central banks on your side or not on your side. In the United States, the government is probably neutral towards Exxon and Chevron at this point because you have to factor in the municipalities versus the federal government, and eventually the federal government will jump on the side of the municipalities. I think that there's likely to be a blue wave coming at some point, and we'll see. Maybe I'm wrong about that, but ultimately the long-term trend is in favor of alternative energy from the governmental side, even if we're fighting it in this country right now. Fundamentals of Total are better than Exxon and Chevron, and the price trend on Total is better than Exxon and Chevron. Overlap their charts. Total does better. So you go through all those things. Oh, by the way, the French government has a partial ownership stake in Total, so they're going to work with them. If you really, really want an oil major, you want that type of safety, right? Or what you perceive as safety, go with Total over Exxon and Chevron. I don't own Total right now. I've owned it in the past. I don't own it now. I'm looking for a bigger bang for my buck. But if you're the type of investor that wants something safer, that pays out a dividend, and get you a little bit of growth to boot, Total is the one. I would sell Exxon and Chevron right now and swap over to Total. The other company that I really like is Occidental Petroleum. And I've been talking about this company since last year. I first recommended it down around $60 a share. It's up around 76 right now. Pays out a 4+% dividend, and its quarterly year-over-year growth is really, really looking good in the last 12 months. So, man, that wasn't that exciting. If you're looking for a play that's a leader in many ways, I take a look at Occidental. They're actually also a buyout target. I think if Exxon and Chevron get desperate and they can afford it, I think they take a run at Occidental. Company has a very high cash payout ratio. However, in the most recent quarter, it dropped dramatically, and it's going to keep dropping dramatically. Their payout ratio, if the oil price holds up, is going to drop down to 50-ish% by middle to late this year. So just keep an eye on that. This is coming down dramatically right now. And because it's not a major, right, because it's much smaller, they can make those big percentage changes, right? The law of small and big numbers really is more in favor of $25 billion company versus, however big Chevron is right now. What's Chevron? 230 billion, right? So you take a look at Occidental, 58 billion, my fault, 58 billion. It's easier to move the needle here. And if you take a look at the chart, just in the last year, you'll see, we were buying it down here, came up here. I actually wrote a couple covered calls. The stock went down, and now it's back up. I think it's going to test this level. I think it's going to test this level right here. I think it's going to break out. I think you're going to see a stock gets all the way back up into this range. It's going to test its highs. 130, something like that, 120. But yeah, $100 stock probably. For those of you, again, looking for something a little bit safer, this is the way to go. You all know my feelings about my favorite oil and gas stock. I'm not going to put that one on the YouTube yet, although I have written about it. Heck, let's talk about it next. In any case, Occidental, largest producer in the Permian Basin, although with the Concho and RSP Permian merger might get bumped to second. But the thing that people are really missing about Occidental is their export capabilities. So the company has a great pipeline network in Texas, and they've been expanding it. But they've also they have the port over in Corpus Christi, and it's the leading oil export port in America, and it's been getting expanded. So they're going to be able to allow even bigger ships to come through here that should be able to carry 2 million barrels of crude. You're going to want to take a look at what they're doing down there, because I don't think anybody really is talking too much about the oil terminal. This oil terminal is going to be remarkably profitable for them, because the American refineries, we have to remember, American refineries are configured, at least down in the Gulf, the Andeaver one up in North Dakota, that's set up for light sweet mainly. But although I think they do both. Actually, the expansion though was light sweet. They get oil from heavy oil from Canada as well. In any case, down on the Gulf, most of the refineries are configured for heavy, right, sour, which is what we've been importing. But what we are producing is light sweet crude, so we're exporting a lot of it. That's where some of the price efficiencies come from. I said 7, 8 years ago, we should have built a light sweet refinery right in the middle of the country. I mean, somewhere near St. Louis, maybe, or somewhere south of St. Louis. I don't know, maybe in Oklahoma. They should have built one and connected it to some of the major pipeline networks. They didn't. President Obama wasn't going to support that, and it might be too late now. But because so much of this oil in the Permian needs to be taken away to other markets, this terminal is it's almost like having a pipeline that you can charge for access to, right? So I like Occidental. At this point, you're not buying it because it's a value, like when it was $60 a share, but you're buying it because it's likely to break out. And here's when I would buy it, and Total for that matter, and the other oil companies. In May, in 3 weeks, and that's an article that I'm writing for Monday. In 3 weeks, I think the Iran deal is going to be put to bed. I think that President Trump is going to decertify the Iran deal. And based on the way the system works with sanctions, that could result within 6 months of 2 million barrels per day coming off the international markets. Now, I wrote that article as well, and again, was mocked. So, when I'm right, I'll point it out, and if I'm wrong, I'll point it out. So a month ago, I talked about the end of the nuclear deal with Iran. You should read this article if you don't understand what's going on. First of all, Mike Pompeo is a hawk, and so is the other guy that he hired. But the way the system works is this: if we put snapback sanctions on Iran, it's not like the other parties to that agreement. Yeah, John Bolton, thank you. It's not like the other parties to that agreement can just say, nah, we don't want to follow sanctions. If they don't follow the sanctions, they get excluded from the United States bond markets and banking system. They don't want that. So what would happen is this. Iran would have to just idle lots of production probably, or let it store up, which they do that to begin. China would probably take as much as they can right before the sanctions kick in. They'd probably take everything, right? Because then they can get a deal. And China knows that. China's not dumb. They know what we're about to do, and they're prepared for it. So they'll sneak in there with a huge oil purchase. At that point, though, the supply coming from Iran, which is about 2 million barrels a day being exported, starts to come off, and it probably comes off over a 6-month period if the way that sanctions were imposed in the past are imposed similarly. Could be day one. But President Trump has put waiting periods on the recent tariffs, so I don't expect that would change. So who supplies that 2 million barrels a day later this year? Pretty easy answer, right? Saudi Arabia. They're trying to go public with Saudi Aramco, and if suddenly there's a much tighter oil market that they're pumping into, and they have 2 to 3 million barrels a day of spare capacity, right? These numbers just happen to match up. Now, I think that's a legitimate coincidence, but Saudi Arabia has between 2 and 3 million barrels a day of spare capacity that they can get to within months. And I believe them when they say they could add another 2 to 4 million barrels a day within a couple of years. So keep that in mind. Saudi Arabia really does have a ton of oil, and at least relative to everybody else, and it's the cheaper kind. So that is the future of short-term future, and I'll be talking about this in depth with Dale Pinkert on Tuesday. So I'll get prepared for that. But keep in mind, you want to get positioned for oil bull market soon. The share prices of the stocks haven't gone up all that much yet, right? So the price of oil has tripled from the bottom, but oil stocks certainly haven't. They've done very little in the last year or two. So they've gone up, they've gone down, they've started to go back up. Once these sanctions are back on, I think they're going to shoot up a lot. I'm not sure how somebody got unmuted, but they did. So quiet down until I find the control to quiet you down again. What kind of questions do you have so far? XOP, the Spider oil and gas exploration and production ETF XOP. I think that is the absolute easiest way to get into the space. If you take a look at the holdings of XOP, you see a who's who of shale players and some Gulf players. So this is the easiest way to get in, right? If you don't want to have to pick out companies, use this. And, folks who are subscribers see a few companies that I've talked about. Occidental is right here. Andeaver is right there. But there's other companies I like. ConocoPhillips used to be on the very short list, but it went up in price, and I just think it got, maximum value for its growth potential. But, Continental, big shale play. Whiting, big shale play. CO2. Murphy Oil is a good company. Apache is very well positioned. They're in the Permian, but they're global. I wish they'd sell some more assets. Marathon Oil is positioned very well. This is an old standard oil company. I mean, I should put up the chart one of these days. It's kind of amazing where all those companies went to. Hess, good company. Newfield Exploration, pretty good. RSP just got bought by Concho, which is not on here. They're not on there. So they will be. Anadarko, I like Anadarko. Anadarko, interesting stock. They have virtually none of their production hedged. So I'm studying this one right now. I haven't studied Anadarko in a while, but I think that this might be something that I add to our list, because their hedge position is minuscule. So they're really very, very levered to rising oil prices. So I'm going to take a look at the math, and I'll let folks at Margin of Safety Investing and Fundamental Trends know what I come up with. But they might be breaking out here. And then news in a few weeks. So I want to get this done in the next week or so. They could break out and go back over 100. So it might be an option play, right? Low dividend. I don't care about that dividend. But I might buy some calls on this if they're cheap enough. All right. Long leap calls. XOP versus XES. I like the production companies a little bit more at the moment, but I don't think you get hurt with either one. You have to take a look at the pricing on the options. If you normalize the returns for these two, the production companies have done better over the last year. Over the last 3 years, a little bit better, a little less bad. Let's take a look over 10 years. Yeah. Yeah, production companies have done well. The one thing you can say about the service companies is that they could have a major rally, right? A straight up type of rally. When you take a look at the holdings for the service companies, what you want to do is break it down by the major players. Now, here's one that I hate. I hate Rig. I hate Diamond Offshore. So there's actually several companies here that I don't like at all, which might cause. This will probably be the first ETF I sell, right? I own it now, but I like XOP better. That's the one I will have the leaps on. I'd stick with the XOP leaps. I own some SU. Yeah, I like SU too. Up there in Canada, hey, right? So the Canadian oil sands, here's what's good about those. They already have their sunken costs, right? So as the price of oil goes up, they become very profitable if they're smart enough not to dig more. And most of the projects have been canceled, in fact. So I think that probably you have pretty good upside with Suncor, and it's actually one of the ones I've been looking at as well. So between Anadarko and Suncor, I've actually been looking at both of these. Cenovus, right? That's what CVE is, Cenovus. I don't know a ton about. Just from that chart, it looks like it must be pretty speculative. Debt to equity is not bad. Price to book is good. Where are they? Do you tell me about Cenovus? What do you know about them? That's something I don't know much about, so you might have to take a look. Yeah, I wish I could tell you. I wish I could give you an answer what I thought about. Oh, that was what was spun off. Okay. Yeah, I don't know much about them. Sorry about that. I'm not real excited about oil sands. If I was going to have one or the other, I think I'd probably stick with Suncor because at least they're kicking out a bigger dividend. And, it kind of looks like they're starting to break out too. I think a lot of these companies are just starting to break out. Look at that. So, next 3 weeks, if you don't have an oil position in the next 3 weeks and these prices start to roll on you going into summer and if those sanctions end, like I believe, you got nobody to blame but yourself. We've been talking about this since way down here and way down here, right? This is a really pretty constructive trend. Had the pullback here because the narrative was bad. Had that little soft spot, and all the bears went crazy. Flood the internet with articles. And now that it's going up, I'll tell you what. I know futures traders, real futures traders. They've been getting long. Every dip they've been getting long, so they were buying down here. I actually play poker with a kid who's doesn't even understand what he's doing, but he's making money doing it. He's been buying oil futures, so I think the market will bail him out. Hopefully, he's smart enough to sell up here somewhere when the oil futures get into the 80s and 90s. All right. I think that's all I got for today. We're going to keep it short. But I would tell you, this is an important chart to understand. Everybody wants to call me right now when I'm not available. There we go. That blue line that I drew in there, see, not the EIA blue line. I'm saying that the EIA is wrong. Supply will stay under demand until EVs really start to put pressure on. And then supply will exceed demand. Why? To keep prices down. So we'll be on this peak oil plateau, $80 to $100 oil, probably better part of a decade, excluding recessions. And during recessions, you probably, if you can sell ahead of it and then buy back. That's actually something that I'm writing for the margin of safety and fundamental trends investors, is how to manage these trades in coming years. And I think that that's really very important. Natural gas. The problem with natural gas is that there's more of it with oil production, right? So as oil production goes up, associated natural gas production goes up. Plus, there's 2 pipelines going into the Permian to pull out all that natural gas. I really like Antero, which is one that somebody's talking about here, because of where they are specifically. So when I take a look at these companies, I start with the sector, and then I try to figure out who's got the best strategic position. People ask me about Southwestern Energy because they're cheap. I'll tell you what, I'll take Antero every day of the year over them. So, do I think natural gas is going to run? Eventually. Yes, I do. However, I think it still might be a little bit challenged. I'm going to continue selling puts on Antero and then covered calls when they have their little pops until we see natural gas inventories come down a little bit more. I think we have to be careful with the natural gas positions. Yeah, I hate when I get linked to zero hedge, but yeah, we'll see. Inventories will rebuild quickly this spring. Yeah, so we'll see. We'll see if that is true. The associated natural gas production is big, so we have to be aware of that and make sure it doesn't get out of hand. Why didn't KMI pop after the news Alberta? Yeah, so I didn't look at that today. Did the government finally bail them out? I mean, I know that Trudeau is trying to get that pipeline done. British Columbia is fighting it. I don't fully understand how the provincial versus federal government works up there if British Columbia really can block it forever. But I do know that they're being told they won't get energy if they can't have the pipeline. So we'll see. I don't know what the legalities are there, but I think that it's good for Kinder no matter what, right? I mean, Kinder Morgan either gets that pipeline on schedule or close on schedule, or the government throws in money. I mean, the government's talking about partnering with them on that just because Kinder Morgan's starting to throw their hands up. So one way or another, I think Kinder Morgan comes out of this okay. I still think there's a lot of hate for Kinder Morgan, and that's precisely when you want to buy them. Go on the message boards anytime somebody puts up a Kinder Morgan article, and you'll have 100 people coming out of the woodwork. Oh, I got kindered. They screwed me 3 years ago. Well, there was an oil crash, an oil and gas crash. I'll tell you what, Kinder Morgan was on the leading edge of converting MLPs back into the corporate structure. And now you see companies like Venom doing it, right? And that's a Permian pipeline that is owned by Diamondback Energy, which if I had woken up to that earlier, I'd have bought Diamondback Energy a long time ago. So Venom is one to look at, Diamondback Energy on pullbacks, but they're so expensive. I have to keep the very short list short somehow, and we've got 10, 12 energy companies on there already. So there are other stocks out there we can look at. So as I build the spreadsheet out, right? And I've put in the section for trading stocks. We're going to have cyclical trading stocks, and these should go in here gradually over time as I find them. When I do 2 days of research, I usually can fill up a half a chart. The alternative income investments are starting to fill in. The model asset allocations we got going now. I put in the initial retirement dividend income portfolio. Punch card stocks are going to go in soon. And we'll start with what we've already bought and owned, and I'll put in the dates on the tracking side. So we'll have all the positions in there. Building these spreadsheets wasn't wasn't easy. I had to steal them first from somebody else and then make great modifications, not really being a spreadsheet guy. So thank you to Rich out there. You know who you are. I've been getting some help with the spreadsheets. Anybody else really good with Google Sheets? Find a way to help. You find a way to help me out with these. I'll find a way to help you out. I've been offering free portfolio reviews, which I normally charge $1,600 for. All right, Canada Pipeline is half their backlog. Yeah, right. So I like Kinder Morgan. I have a hard time thinking that their share price isn't going to go up at least 50% from here, maybe double. I mean, I wrote the article that they should double. And for those who want to try to steal that URL, I change it pretty frequently, so don't bother. Yeah, I like Kinder Morgan. I can't tell you that their network is irreplaceable. Can't be replaced. Look at that. Now look what it did. It was way up there. Bam. A little bit of rebound. Investors get impatient. They focus on the negative. And at some point, that curve starts to turn up, right? You start getting a divergence, and you start going, I'm actually surprised that it came back down to 15, 16, whatever it's been at lately. I think that this is going to end up being the test, right, to survive the test. So here is your bottom, down around 12-ish, right? I know they got down to around 12-ish. I think this was the test. I don't think it's going to turn over again. And if these moving averages, the 50-day starts to move towards the 200, and you start to get a breakout around 18, I think you could see this thing go all the way back up into the 20s. I think maybe into the 30s, but that'll be a few years out. But they just increased their dividends 60%. They're scheduled to increase it more. I think Kinder Morgan's a really good one for growth and income, total return. I think you're going to be pretty happy with it. Now, is it a go-go stock? No. We have to go to the technology stocks for that. But, some of these oil and gas companies, I think they're going to be really good for the next several years. And we'll talk about what to do when a recession comes and how to get out, how to get back in. We'll talk about how far to ride them at the end of the secular bull market. What to do with the cash when you have it on hand. I think that if we stick in the intermediate term with this oil trade and longer term with the smart everything world trades and the alternative energy trades and a little bit spread out for diversification, and over the next few years, we're going to want to, because there will be a strong dollar event, and when that comes, we're going to want to buy India. We're probably going to want to buy Vietnam. We're probably going to want to buy Mexico. We're probably going to want to buy Brazil. There are several countries out there that have those combinations of rule of law, younger populations in most cases, resources in most cases, education, something to do with China, right, or the United States. Those are, and India's got its own secular growth story. If they can get out of their way, and I think Modi is doing a good job of that. But Australia on a pullback, you buy them. Why? Because it's a backdoor play into China without having to deal with China. And I've gotten burned on China, and I'm super careful about investing in them. I'm looking at Tencent, but China, I don't know that I trust them. Would I trade them? Sure. Would I look at it as something I want to own for 10 years? Man, I just don't know. I'm afraid of waking up and my money being gone. All right, I think that's it for today. Have a great weekend. I will get this on the YouTube channel here later this afternoon. And, as always, feel free to send me questions, and, I'll try to answer them. But if you get a chance, at a minimum, check out the YouTube channel of Forex Analytics too. You can pull up my old interviews with them on YouTube. Just put Kirk Spano into YouTube, and it'll pull up the interviews, and not only with him, but also with David Modell. If you know, David Modell has some eclectic stuff. He talks, cannabis stocks, and here, I'm going to show you this just before we go. Yeah, I like Enbridge too. Not as much as Kinder Morgan. Oh, there you go. So take a look at David Modell. Follow him on YouTube. Follow him on Twitter. He passes on some good stuff. His interviews are pretty amusing. He really likes the marijuana stocks, and I was actually going to do a whole series on them. I just don't have time, because there are actually a couple of things in the marijuana stocks that are worthwhile. 90% of them are scams or just bad or overpriced, but there's a handful that have some potential. And when I say potential in marijuana stocks, it's takeover potential, right? The good brands in marijuana stocks, the ones that are legit companies with legit products that lots of people use, those are the ones that Philip Morris and Altria are going to go out and buy. So anyway, he talks about the MACD indicator. I've posted this on Twitter before in Bollinger Bands. So these, relative strength index, these are pretty good videos. I don't know what this is. So the big reset is coming. Yeah, he's got some crazy people on here too. This lady right here, man. Did I show you this one last week? Yeah. Yeah. I'm sorry. I shouldn't be doing that. I'm trying to be a good Catholic. But in any case, somebody doesn't like Enbridge. All right. In any case, I'm gonna let you go. Have a good weekend. If you're in the Midwest, hopefully it gets over 50 finally. I was gonna barbecue tomorrow, but that's off. So I don't know what I'm gonna do. Probably go play poker. That's kind of my thing. Have a good day.